it was mandated by Congress that this waiver be put in place during the crisis to help stabilize. So people were able to use the FHA program if the property was being resold. That waiver was not extended by Congress by December 31st of 2014. So the normal waiver went back into place. So a buyer purchasing a home that's being resold within 90 days of the seller's acquisition of the property cannot use FHA mortgage insurance to do that. Doesn't mean that they can't buy it using FHA. It just means that the purchase contract cannot be signed until the 91st day. That's all that means. And then if the property is being resold for more than 100% from the 90th to the 180th day, then a second appraisal to justify the value is required. That's all that means. As it relates to the mortgage insurance premiums, across the board, the upfront mortgage insurance premium is 1 3/4%. The annual premiums had increased. We were trying to increase them slowly to offset. We have a congressionally mandated reserve requirement of 2%. And again, because our mission is to help stabilize the housing market, we were making adjustments where we could, where we knew it would not have an impact on slowing the resale market down. Congress did not feel we were acting fast enough. So they actually mandated that last jump, this severe jump to 1.55% on the annual premium. Effective January 1st of this year, though, our secretary was able to reduce it down to 1.05 for someone doing maximum financing for a 30-year loan. So it runs anywhere from 0.45 all the way up to 1.05. Now, one of the things that I know realtors are concerned with, and I speak about this everywhere I go, is there's the complaint that the monthly mortgage insurance premium runs now for the life of the mortgage, right? That's a big deal. It runs for the life of the mortgage. What I'd like for you and your members to understand is to look at the way it was done before. And when you look at the way it was done before versus the guidelines that are in place today, you'll find in many cases it really makes no difference, right? The old way that it was done, that monthly mortgage insurance premium would have only dropped off when two conditions, and both of those conditions had to be satisfied. And that was that the loan reached a 78% loan to value, and the loan was open for at least 5 years. And when we calculated that 78% loan to value, that was based on original sales price and original value. You couldn't come back and give us a broker opinion of value, no new appraisal. It was based on when the loan was made. So based on the old calculation, that monthly mortgage insurance premium would have never dropped off until almost 11 years. Right? So most people, the average term of a mortgage in the United States, including Hawaii, is only 7 years. So it would have never dropped off before either. So even though it runs for life of loan now, same thing. If that law of averages hold to 7 years, it's going to drop off when they sell or refinance anyway. So keep that in mind. While it seems disastrous that it's life of mortgage, is it really when it's put in perspective? Then the other thing that we'd like for realtors to realize and to understand, you have very few mortgages in the United States, Hawaii, that are assumable. FHA loans are fully assumable. We do require credit qualifying. So, of course, credit qualifying simply means their ability to repay the loan, so income, and their credit. We want to make sure that they handle their obligations right, because if we have a performing loan, we want that loan to continue to perform, but no new appraisal is required. Now, is an assumable mortgage a big deal today when interest rates are 4%? No, we both know that. But anybody that's been in the business any length of time, it really wasn't that long ago that interest rates were 12%. Right? In the early 90s, mortgage interest rates were at 12%. So for realtors, when interest rates go up, purchasing power goes down because you need more money to qualify. Purchasing power goes down, so do values, right? So if you have a loan that's assumable, it may be able to sell, you may be able to sell at the higher value, have the buyer assume that first mortgage, and then come up with the gap financing, right? The second mortgage to fill the gap between the sales price and the assumable balance of the mortgage they're assuming. So FHA, USDA, and VA. And VA is only to another veteran, right? But USDA and FHA really are blanket assumable mortgage. So it is something, you know, you put it in perspective that way, and it's a big deal. Mortgage insurance premiums also protect the borrower or buyer in the event of a delinquency, right? We all have hiccups in our lives. Someone who maybe broke their leg, right? Can't work for 3 months. Disability is not going to be enough to cover all their obligations. We require the servicing lender to work with that borrower to keep them in the home. Someone assuming that mortgage gets those same benefits. So they're assuming everything. They're assuming that low interest rate, and they're assuming the benefits of loss mitigation.
Great. And remind us again, what are the FHA mortgage limits in Hawaii?
Well, they vary by area, but Honolulu specifically. And remember, there's another thing I want realtors to remember, that FHA just doesn't lend on one unit, right? We do 1 unit, 2 units, 3 units, all the way up to 4 units. Buyer must occupy one of those units, right? Because we only do owner occupancy. So if you're buying a 4-unit, buyer has to occupy one, the other 3 can be rented. So loan limits vary based on the number of units, and they go up. So for Honolulu, for 1 unit, the loan limit is $721.50, $721,050. 2 units, it's $923,500. 3 units is $1,115,800. And 4 units is $1,386,650. And they do vary. Like Maui, I know Maui's limits are a little bit different. Oh, I am so sorry. I apologize. I meant to put it on the airplane mode. Sorry. I will do that right now. Okay, so go ahead. I'm sorry. So it's important that people know that it's not just 1 unit. It's up to 4. So there are some opportunities. You know, we have an aging society. I mean, whether you're here in Hawaii or you're on the mainland, a lot of us are taking in family members. And maybe while we don't necessarily want them under the same roof, there's a little granny's quarters across the yard might be perfect. So that's something to consider. It's a way to bring folks in and keep them with us, but not necessarily under the same roof.
So explain to our viewers how FHA can help the first-time home buyer.
Oh, there's a lot of different things that we do. FHA does not provide any benefits to first-time home buyers. There was a program that was being considered last year called Homeowners Armed with Knowledge, right? HAWK for short, because of course we have an acronym for everything. So it was HAWK for short. Congress did not approve that program. So we don't have any benefits to first-time home buyers, but where the benefit really lies is that we allow for manual underwriting on every loan. So someone maybe with minimal credit or alternative credit, because you have a lot of cultures that necessarily have been taught from the time they were little. You don't buy your car at one of the big car makers. You buy it at Joe's down the road, right? You pay Joe every week. And they rent, and they've been renting, and they have a good rental history, and they pay their utilities. And maybe, you know, layaway is a form of alternative credit, right? I remember my mom used to buy my winter coat every year on layaway. You know, at the beginning of the school year, she'd let us pick out our coat. By the time the first snow came, our coat would be paid for. Layaway is another alternative form of credit. So those first-time home buyers with limited credit might be able to get into an FHA loan where they wouldn't elsewhere. Fannie and Freddie, for example, don't allow for manual underwriting where FHA does. So if that buyer doesn't fit in that box, they can't purchase, where FHA allows for that. Many lenders still do manually underwrite their loans. I understand Fannie and Freddie have now come up with a 3% down program, so you know they're competitive as far as FHA's 3.5%. That 3.5% could be 100% gift. though, from an immediate family member, from a close familial tie. There's a variety of sources that money could come from. The city, county, state might provide down payment assistance, which is acceptable for FHA. So technically, then, some of the programs, and it's not possible for me to know, because overseeing and doing training in the 8 Western United States, my head would explode if I had to remember every city, state, county program, right? So any members should know the areas that they farm and that they market, and know what down payment assistance is available, because some of the programs not only provide the down payment assistance, but the closing costs as well. And see, FHA, here's a difference between Fannie and Freddie. The combined loan to value with FHA could exceed 100% with acceptable secondary financing, allowing for the closing costs and the down payment. So there are some benefits to first-time home buyers using FHA.
That's great. And tell us about the rollout of the FHA Single Family Handbook, and what can we expect from this resource?
Well, I'll tell you. It's, and I brought with me as an example, I guess I left it in my bag. The rollout is going to be September 14th. It was originally scheduled for June 15th of this year. However, the TRID, which everybody is dealing with, CFPB, the Consumer Financial Protection Bureau, was planning on rolling out their new documentation on July 1st. So we thought, all right, we'll back off a little bit, because, you all have to deal with CFPB, and we recognize the challenges, because we have to deal with them just like you do, right? I mean, you're 2 federal agencies going head-to-head with each other on some issues, so we have to comply with their requirements as well. We thought that rolling out the handbook on June 15th would have been too much between the two, so we backed ours out to September 14th. Ironically, now CFPB has backed up to October 1st, right? Exactly. And we've been asked, so now are you going to back up again? And our answer is no, we are not going to back up. The new handbook is called the 4000.1. It will be all-encompassing and all-inclusive. We are eliminating mortgagee letters. Once we roll this out, everything will be gone from our website. We are condensing every single handbook. I think there's 11 different handbooks and over 4,000 mortgagee letters that will be compiled into this one book. It will be all-inclusive. It will be the only resource that is the actual formal resource for FHA mortgages. Every one of your members, as well as the public, will have access to it on all regs. We contracted with all regs, which frankly they do a great job with managing information for Fannie, Freddie, VA, and finally us. We're thrilled. We're thrilled. So you can access all regs, search for FHA, and then anything you can search for it by keyword. You can do it by category. Excuse me, I'm okay. It's going to be, I know, working in private sector and now coming in, it's absolutely the best format for your members. They should be able, when an underwriter tells them something and they're not quite sure they're getting the truth, they could go directly to all regs and find the answer themselves. A lot of times your members, and we know your members are dealing with, well, that's FHA's rule or that's FHA's regulation. Your members today could find out that information if they wanted to, but our website is a bit of a challenge sometimes to find it. All regs should make it easier for them. Lenders will tell you that FHA's FICO score is 620. I'm here to tell you it's not. Okay, our absolute minimum FICO score is 500. It's just that between 500 and 580, we allow for a maximum mortgage of 90%. It's always been the case, okay? 580 and above, we allow for maximum financing, 96.5%. So when you have a lender telling you that no, FHA requires 620, it's not. All right, and the information is there. We did some webinars for the association a couple of years ago. We went through all of our programs, and maybe we want to think about coordinating that again, especially after the rollout of the new handbook. On our website, and I will get you, last week I created a really good tool that provides a link. We have on our website right now modules that take you every step of that handbook. I mean, literally every step of that handbook. There are 9 modules out there. So your members can view them. It doesn't cost them. It's HUD staff providing, basically we're providing you the handbook in PowerPoint format. You're hearing us, you're hearing some explanations. I'm actually one of the presenters that's on the modules. Mine is on our special programs, building on owned land, for example, Department of Hawaiian Homelands. I cover that module. So mine are the special programs and products that we have, but they are available, and I would recommend that your members view them, because it's invaluable and it will take them through beginning to end. What won't be incorporated on the original release of that handbook are the condos, because you're still going to have to revert back to the 2009 and 2012 mortgagee letters. We are in the rulemaking process. We are absolutely at the final stages. So we're hoping that once the rulemaking, when we put out for a rule, we have to have an open comment period that runs 60 days. If we want all the responses that we get back, every single response, if we got 20,000 responses back, we have to respond 20,000 times. So the rulemaking process is not an easy process at all. We're hoping to get it out as soon as possible. We've been working on it for more than 4 years. So at some point in time, that will be incorporated. Some of the reverse mortgage, the home equity conversion mortgage, because realtors maybe don't realize that a buyer can purchase a home using a reverse mortgage and not have any payments. So let's say you have someone who's downsizing. They're still in equity situation. They still have to come in with down payment, but they may not have to use all of their sales proceeds to buy that house and be able to buy with no mortgage payment. So that handbook will be, that portion of the handbook will be incorporated as well. But September 14th, all regs, and it's free and open to the public.
Well, thank you for that. Now, you briefly touched upon the condominium approval process. What are the condo approval processing options, and can you share how they differ and the advantages, if any, of choosing one over the other?
Yes. There are 2 forms, 2 ways that a condo project can be processed. One is through direct endorsement lender review and process, which means your local lender could review and process the project, or it could come into the homeownership center for us to review and process. If it comes into us, our processing time is approximately 14 business days. There are advantages and disadvantages to both. The disadvantages is you may not have a lender that quite knows what they're doing, right? And then once they review and send it in, they'll review and process it, but if we later find out that they didn't do it right, well, that project may be approved today, it could be pulled back, withdrawn tomorrow, all right? So coming into us, though, you have the wait time.
Right.
And if the submission of a condo project can come from a homeowners association, could come from a management company, it could come from the owner, the individual condo owner. It cannot come from a realtor. It cannot come from an outside, and it obviously could come from a lender as well. I don't recommend, there are a lot of entities out there willing to charge HOAs to process it and submit it to the homeownership center. Why they would want to pay, I struggle with, because it's free for us to review the project. You know, it may take some time if you don't follow. We have on our website, it was Mortgagee Letter 2009 was the original, then we updated it in 2012. There is an entire 96-page attachment that walks you through step by step the documentation that's needed. So as long as, and there's checklists that go along with it. As long as those checklists are followed, it should be no problem when it comes into the homeownership center, right? But if you're missing, like, for example, we need the CCNRs, we need the bylaws, the articles. If you don't send in those 3, but you send in the budget and everything else, you're not, you know, we're going to let you know that you start from the beginning again. You start at the bottom, right? It's not like a lender where we condition for documents, right? You start at the bottom, so it could be another 2 weeks. Now, if it's minimal, if it's one piece of paper that's missing, we'll send an email and we won't do that, right? But you have to understand that you're not the only one. There are other people that are waiting for their approval as well. One thing I do want to share with your members, though, is when in 2009, when we made the changes, the certification that the homeowners association had to sign, or the attorney representing the homeowners association, or the management company, that certification held that person responsible forever. Forever, even long after they're gone, even after they're 6 feet under, right? So many condo projects, the HOAs, the management companies, the attorneys said, we're not signing that form. That's crazy, right? Why would I hold myself out? I'm only going to be here. I know I'm moving to Alaska in 6 months. I don't want to be responsible for something I'm not involved with anymore. So we recognized that. In 2012, we made a change to that certification that only makes the person responsible for the information that they provided as of the day they signed that certification. So many, the projects that fell off, that looked at the original certification, nobody went back and said FHA changed it. Do you want to reconsider? So for your members, and no matter where I go, I say to a realtor, you want in that project, go back out there and explain FHA has changed. I know that NAR is working with the the Orange County Association of Realtors right now, because OCAR realized it, and they created an informational video to take around to the local homeowners association, and NAR put up additional funds for them to advance it further to an education piece. So it's something really that if your members went back out and say, you know, you were FHA once before, and that promotes homeownership, right? That promotes homeownership to first-time home buyers. A lot of times you might hear a comment, and I hear this regularly in California, is we don't want our project FHA approved. That's a lesser quality buyer. I'm here to tell you that $721,000 is not a lesser quality buyer at all. I can't afford a $750,000 house, right? So, and I think I'm pretty high quality. So it's a perception, and your members would help in that perception, but that's a way to get their foot in the door and potentially more sales. And more sales translates into more money in their pocket. So, but that checklist is there, and it's easy to follow, and it breaks it down. It breaks it down whether it's a new project, an existing project, a conversion project, whether the builder, because of course during the height of the crisis, the housing crisis, a lot of builders had to sit on those projects. It talks about what to do and if that's the case. So there's ways to work through it.
Well,
And it's not that difficult. You're welcome.
Now, how long does the process take, and what is the turnaround time?
If it comes into the homeownership center, it's about 14 business days. The lender, I can't answer for the lender.
All right. And what are the owner occupancy ratios, and how can they be adjusted?
We require that a condo project be 50% owner occupied. To be classified as a second home, and that is covered in the handbook, in the mortgagee letter, the attachment handbook. It's going to be a bit of a challenge to really truly determine whether it's a second home versus a rental, because when it's second home, that falls under the Code of Federal Regulations requirements of the definition. It's not our definition. We're just following law as well. So 50% owner occupancy, which is better than what it was prior to the Housing and Economic Recovery Act of 2008, because prior to that, it required 51% owner occupancy. So it improved it a little bit more. One of the other challenges I know that you have in Hawaii is commercial space, mixed use. With the new handbook, you will be, when the condo section is published, and it may come out earlier, sooner than that, it may come out when we release the handbook. The commercial space, you know, we had this really strange calculation, right? I mean, anybody in their right mind would have to be a math genius in order to calculate it, because it was this percentage of this and this percentage of this. Now it's going to be a straight 50%. 50% cannot be more of commercial use, and that's total square footage of building. So it's no more, okay, so we have a lobby area, is that homeowner use or is that commercial use, right? So it's going to be 50% of the total square footage of the entire complex. So that should help tremendously moving forward.
Now, what if the builder developer owns the units?
A great question, and that's contingent on the stage of building, right? Because again, we understood that the market had crashed, and it depends on where they are in phases. If it's an existing project that's more than a certain period of time, you're going to have an issue if the builder owns. If it's new and the builder's still in development stage, it's understandable that the builder would still own some of the units. Or, it's, again, that new construction, that construction less than 1 year, and then that existing construction, depending on what phase it falls in, it may not even be an issue.
Okay, but there might be an issue whereas they may be considered investor-owned.
Could be, potentially.
Okay. What is the delinquent association homeowner dues requirement?
Oh my gosh, no more than 15% of all units can be more than 60 days in arrears. How's that? Wow, I can't even believe I remember that. No more than 15%, 60 days in arrears. It used to be 30 days. See, that's one of those other changes that people didn't pay attention when we made that update, because all those condo projects had fallen off. You have to understand what happened to them. Let's go back to why this all happened. We had condo projects that had been on our books for 40 years. One loan was made, it was never made again. So you don't know what's going on in that project, right? And probably in Hawaii, like California, we had builders that wanted to be able to sell to everybody, right? And show we're VA approved, we're FHA approved, and they got phase 1 approved. But then they built phase 2, 3, 4, 5, and never got the other phases approved. So you had this one phase, and a few loans were made initially, but none of the others. So then that started the spot approval, right? The spot condo approval process. Well, okay, we had the first phase approved. It's just one unit. What's our risk? Well, it got to be too messy. I mean, you'd have one unit in a project that was never approved before. So we said, all right, this needs to be cleaned up. This stuff that's 40 years old. There are some projects that don't meet our loan limits. They'll never meet our loan limits. You have areas that the sale price is $1 million, right? So just clean it up. And we gave lenders and condo association 2 years to come back in and seek reapproval. Those that had fallen off either were not trying, no one was trying to get an FHA insured mortgage, or they just didn't care. Right? And that's the reason that they had fallen off. It's not, there was no desire. And now there's desire again, obviously, because our loan limits are up. And many of the areas, our loan limits will more than meet the needs for some of these projects.
When do these temporary condominium approval guidelines expire and the final rules put in place?
I know they're hoping by the end of this year. But, again, depending on the number of comments that we get back, it could be pushed back out. But I know the push is to try and get it out there. We're trying to get that handbook completely done by the end of this year.
Well, thank you for the great dialogue and explanation on these very important questions. Let's get to viewer questions. Once again, please identify your island or city, followed by your question. Oahu. Will FHA approve a property that has permit issues?
Most likely, yes. If you have permit issues, then obviously it's not acceptable. FHA allows for, let's say, a room addition. Right? That's as long as it can be rebuilt. If it's destroyed, then you don't have an issue. However, if you have a city, county, or state that has something greater, some greater requirement than us, then you have to comply with that requirement. So even though we may allow for it, if the city or county is pushing for that work to be done, you will have to comply. And the appraiser would address that, as would the underwriter.
Okay, well, we have another question from Oahu regarding permits. If permits are required on Oahu, is there any room for exceptions like VA?
FHA's rules, regulations, and guidelines are the stricter apply. Okay, so if Oahu is requiring permits, then we would defer to them.
Okay, great. And we have another question from Oahu. How competitive is FHA with Fannie Mae's product of 3.5% down with their MI?
Our MI, again, it doesn't matter whether you're putting 3.5% down or 5% down. The upfront mortgage insurance is 1 3/4%. I don't know what private sector. I don't follow the PMIs or the Magics or the GEs to know what their premiums are. FHA's upfront, which is financed, is 1 3/4%, and the monthly mortgage insurance premium on a maximum financing loan, 96.5%. For 30 years would be 1.05 monthly. Now, how does that compare? You know, something realtors may not know, especially the younger ones, is that while the buyer might be paying monthly, they have the option of financing an upfront mortgage insurance with these private mortgage insurance and not having monthly premiums. A lot of people don't realize that. Yeah, right, exactly. So, I mean, while monthly may sound better, right, it may not be better in the end, especially if right now, and I don't even know whether Congress extended the mortgage insurance premium deduction, right, the tax deduction, the IRS. So that might be something to consider, because if you finance the mortgage insurance premium, then that's part of your mortgage payment, and it would be a tax write-off. So it's something to consider on the private side when you're dealing with Fannie and Freddie.
Now, another question from Oahu. Will there be changes expected anytime soon for FHA approvals for condos? And how about potential changes to condo occupancy rule?
I don't see the occupancy rule changing at all.
Okay.
And let's face it, our mission is to promote homeownership. When you're in a condo project that's less than 50% owner occupied, what are you really looking at? Right? You're looking at apartment living, right? And it becomes less marketable, right? We all know if you're looking to buy something, you want to live with other owners, right? So the marketability goes down. So I don't see it decreasing below 50%. As far as changes, I do see some changes coming with the new rulemaking. What they are specifically, I'm not involved with. Rulemaking is not done at our level, at the homeownership center level. It's done by headquarters, and headquarters dealing with the Office of General Counsel, because they're looking at so many different laws across the spectrum. It's not just FHA laws, it's Code of Federal Regulation laws, and it can span. For example, we get questions. I just did a webinar recently with our regional administrator on how FHA sets their loan limits, right? Well, it doesn't even start with us. It starts with the Office of Management and Budget, right? The federal office management and budget. Those are the people that anytime you do a government form, it tells you how many minutes to complete, right? So it starts with them. And then from there, it goes to census before we even set our limits. So we rely on both of their data and information to set our limits. Same thing happens with rulemaking for the condos. They've got to look at all the other laws and make sure that anything that we propose for the rule change meets and falls within those regulations.
Well, we have a question from the Big Island. Are there any charges to the seller with FHA compared with conventional mortgages?
As in special fees or assessments or things? The answer is no, absolutely not. As you know, fees are negotiable between buyer and seller, and the only thing FHA requires is when the buyer or borrower is paying the fees, that they are reasonable, customary, and documented. There is one fee that we do not allow, but I understand that's going to be a change in the new handbook. Currently, we do not allow for the tax service fee. There we go. And the tax service fee really protects the lender in the event of a delinquent tax sale on the property. Well, FHA loans require that they be impounded. So if the lender's not collecting it, they would already know. They would need some special notification, right? So we don't deem that as reasonable. But my understanding is with the new handbook, it will be everything and anything, including that transfer tax, the tax assessment fee.
I'm not sure. Oh, the FHA market here has all but died for the past 10 years, as it is not competitive. Will these new laws increase the use of this product?
If we're talking about the condominiums specifically, I can't answer that. I mean, you would know better than I would.
Mm-hmm.
And since the rulemaking is not done completely, you know, based on the way it stands now, I indicated we made some changes in 2012 that folks didn't stay on top of, right? Once it was gone, it was out of everybody's mind, right? Oh, forget it, you know, we've already talked to them, they said they're never going to do it, but we made the change. And if you didn't go back and say, hey, we made this change, how do you know what impact it would have, right? We're to 2015 right now, so that's 3 years that maybe they don't know, so I don't have 3 years of data to look at. Will the further changes help? I think so. Based on some of what I've seen, I do think it'll help. I mentioned the commercial space, the mixed use. That's a huge deal here in Hawaii, right? So do I think that will help? Absolutely, I do.
Since we are in a fast-moving market, waiting to get a condo approved puts us in a situation that we are unable to get the offer accepted. We cannot get a pre-approval letter unless the building is approved. Why is it that FHA cannot update all the records and get the buildings approved instead of waiting till they are requested for?
Okay, so we touched on that. We did touch on that, and we talked about why they fell off, because they hadn't done anything. An FHA loan hadn't been done in there in 40 years, right? So obviously you don't want to do business with us if for 40 years no other loans had been made in there. Additionally, we allowed the lenders 2 years, which in turn allowed the realtors to bring in a borrower within that 2 years where it would not have fallen off. Mm-hmm. So 2 years went by, nobody was interested. Now there's this push on getting these projects approved, and I understand that. I completely understand that. You don't have to wait till last minute. As I mentioned, the homeowners association, the management company, an attorney representing could compile the paperwork based on the checklist and the guidelines that we have in that attachment and submit them directly to the homeownership center. It would come into Santa Ana. We do the review and process and put it up on our website. So it would be there. You don't have to wait for a sale. As I mentioned, you could be the sole realtor, the exclusive listing agent in there, right? For if you went in and did a little marketing from that aspect of it. So you don't have to wait till you have a buyer. It could be done ahead of time. It's convincing the HOA to go ahead and submit it.
Paperwork.
Right, exactly.
Okay. So what is the maximum contribution a seller can make towards closing costs
Great
on
question.
an FHA loan?
Great question. No more than 6% of the sales price or appraised value or actual cost, whichever is less.
Okay.
One more.
What is manual underwriting? You mentioned Freddie and Fannie does not do manual underwriting.
Okay, so everybody, Fannie, Freddie, FHA, VA, we all have automated underwriting through Fannie Mae's desktop underwriter, Freddie Mac's loan prospector. And all it is it's a computer program that reads whatever's input into it, right? So I like to say sometimes garbage in, garbage out. If you don't put the correct information, then your findings may not be correct as well. So Fannie and Freddie only do automated underwriting. So that buyer has to fit in that box. We talked about, here's a good example. A borrower who had a foreclosure or bankruptcy at least 12 months ago that had an extenuating circumstance may be eligible for an FHA insured mortgage. You will never get that approved, Fannie Freddie, because it doesn't recognize what an extenuating circumstance is. It only knows what to read inside that box. Where on the FHA loan, you then revert to manual underwriting, where an underwriter, uses their brain to make a decision on that loan. So they saw that the child got ill and they were in the hospital and the parents ran up $1 million in medical expense. There's no way to get out from under $1 million worth of medical expense. Their credit was fine up until that point. They had a major catastrophe in the family. They filed bankruptcy to eliminate that medical bill, and they've reestablished themselves since the bankruptcy. That very well may be someone that can get an FHA insured mortgage. So manual underwriting allows someone to use their common sense and knowledge to make the decision on whether that buyer is credible. We talked about alternative credit, right? The borrower who buys their car from Joe down the road that uses layaway. That will never be approved. That needs someone to use their brain to make that decision.
Thank you. Are there any charges to the seller with FHA compared with conventional mortgages?
No charges, no. And FHA, many times, and I know for a long time here in Hawaii, your loan limits were not what they are today as well. So a lot of people got away from FHA, and they don't realize that in 2009 we made huge changes to the appraisal requirements too, right? All we require is that the property be safe, sound, secure, free of health defects. There's no mandatory repairs anymore, right? So, for example, you have a crack in the window. In the old days, you had to replace that window. That's not that way anymore. If it's just cracked, does that present a health, safety, or soundness issue? Probably not. Now, if you have a hole in it, you have a whole different situation. Flat roofs, right? You have a lot of flat roofs here. In the old days, flat roof, you used to have a roof inspection. That's not the case anymore, but we changed that in 2009. Many people didn't stay current with our changes. So those are some things to consider as well.